All right, let's dive right in. Today, we're talking about one of the most important, but maybe one of the most misunderstood parts of the entire financial world, bonds. You know, they don't get the flashy headlines like stocks do, but they are, quite literally, the foundation our global economy is built on. So, let's unlock how they actually work.
Here's what we're going to cover. First, we'll nail down the basics, what a bond really is, the ultimate IOU. Then we're going to get into the really interesting stuff, the dance between price and yield. After that, we'll uncover some of the hidden dangers, the real-world consequences. We'll take a quick peek under the hood at some more advanced stuff, and then we'll wrap it all up with a final verdict on where bonds fit in today.
So, first up, the ultimate IOU. Seriously, forget all the complicated Wall Street jargon for a second. At its very core, a bond is an incredibly simple and really powerful idea.
So what is a bond? It's really just a formal IOU. When you buy a bond, you are lending your money to someone else. That could be a government, could be a big company, and in exchange for your cash today, they give you a promise, a contract, that says they will pay you back in a very specific way, on very specific dates. That's it. It's a structured loan.
Let's make this real. Imagine you buy a simple 10-year bond with what's called a face value of $1,000. Okay, so step 1, you hand over your $1,000 to the issuer. Step 2, in return, they start sending you regular interest payments, which in the bond world are called coupons. In this case, you'd get $50 every 6 months for 10 years. Then, step 3, after those 10 years are up, at what's called maturity, boom, you get your original $1,000 back. It's designed to be a predictable stream of cash.
Okay, so now that we've got the basics down, let's get into the part that really drives the market: price, yield, and value. This is where it gets dynamic, because see, bonds don't just sit still. Their prices are always moving, and understanding why is the key to understanding, well, the entire bond market.
And it all comes down to this. This right here is the golden rule. When a bond's yield goes up, its price goes down, and when its yield goes down, its price goes up. They move in opposite directions, just like two kids on a seesaw, always. But why does that happen? Well, here's the logic. Let's say you own a bond that pays you a steady 3% interest every year. But suddenly, the world changes, and brand new bonds are being issued that pay 5%. All of a sudden, your little 3% bond looks kind of lame, right? It's less attractive. So if you wanted to sell your bond to someone, why would they buy it? The only way to convince them is to sell it for a cheaper price. You have to offer it at a discount. That lower price they pay makes up for the lower interest they're going to get. And this whole dynamic leads to bonds trading at either a discount or a premium. So, if a bond's price drops below its face value, say you pay $950 for that $1,000 bond, it's trading at a discount. Your total profit comes from all those coupons, plus that extra $50 you make when it matures. On the flip side, if you pay more than face value, say $1,050, it's at a premium. You're paying extra to get your hands on a nice high coupon, but you know you're going to take a small $50 loss when it matures back at $1,000.
Okay, now for the serious part, the hidden dangers. We've gone through the mechanics, but investing is never risk-free. And even though bonds get this reputation for being safe, they come with some very real and sometimes very big dangers.
You really have to know about two major risks. The first one is pretty obvious. It's called default risk. It's the simple question of, will the company or government I loan money to actually be able to pay me back? But the second one is more subtle, and it can be just as dangerous. Interest rate risk. That's the seesaw we just talked about. If interest rates in the market suddenly shoot up, the value of that bond you're holding goes down.
And listen, this isn't some abstract textbook theory. This risk has caused real-world financial disasters again and again. In the 1980s, you had the savings and loan crisis. In 1994, Orange County, California went bankrupt because of it. And just look at 2023. A major factor in the collapse of Silicon Valley Bank was that its massive bond portfolio got crushed when interest rates skyrocketed.
And to put a number on it, just look at this. The S&L crisis alone is estimated to have cost around $160 billion. That is the destructive power of getting interest rate risk wrong. It's not some small detail. It's a force that can shake the entire financial system to its core.
All right, let's switch gears and get a little nerdy for a minute. Let's peek under the hood at a few of the more advanced ideas that you'll run into in the bond world.
First up are callable bonds. Now, these are kind of interesting. They give the issuer the right to pay you back your money early, before the maturity date. So why would they want to do that? Well, it's for the exact same reason you might refinance your mortgage. If interest rates have dropped since they issued the bond, they can call back their old, expensive debt and then just issue new debt at the new, cheaper rate. And because you, the investor, are taking on that risk, these bonds are usually a bit cheaper to buy. Next, the credit default swap, or CDS. Now, you may have heard this term, especially if you remember the 2008 financial crisis. The simplest way to think about a CDS is like an insurance policy. If you own a company's bonds and you're worried they might go bankrupt, you can buy a CDS. If the company defaults, the CDS pays you out, covering your losses.
So you might be thinking, okay, so it's insurance. What's the big deal? How is that any different from the insurance I buy for my car?
Well, here's the crazy part. With a CDS, you can buy what's called a naked CDS. That means you don't actually have to own the bond that you're insuring. You can just buy the insurance policy by itself. It's purely a bet that the company will fail. It would be like buying fire insurance on your neighbor's house. You're not protecting your own property, you're just betting that their house burns down.
And finally, a little bit of Wall Street lingo for you. You'll hear traders talk about on-the-run and off-the-run bonds. On the run just means the most recently issued government bonds. They're the new, hot items that are super easy to buy and sell. Off the run refers to all the older bonds that are already out there. They're less liquid, meaning a little harder to trade, and because of that, they're often just a little bit cheaper.
All right, let's bring it all home. We've talked about what bonds are, how they work, the risks, the whole shebang. So what's the final verdict? Where do these things actually fit into a modern portfolio?
Well, if you just look at the long-term history, it's not even a contest. Stocks have delivered way higher returns than bonds over time. So if your only goal is to make as much money as possible, stocks have been the better bet. But that's not the whole story.
See, the main reason most people own bonds is for diversification. The idea is that, historically, when stocks go down, bonds often hold steady or even go up, which helps smooth out the bumps for an investor. They are usually a pretty reliable way to do this, with the big, glaring exception of 2022, a very weird year when both stocks and bonds got hammered at the same time.
And I want to leave you with one final, crucial warning, and this is specifically about corporate bonds. You have to remember, the stockholders are the ones running the company, and they can make decisions that are great for them, but terrible for you, the bondholder. Like, they could decide to pile on a mountain of new debt, which makes your bond much riskier. And in a really bad recession, when the fear of bankruptcy spikes, these safe corporate bonds can suddenly start acting a lot more like risky stocks, which can wipe out all those diversification benefits right when you need them the most.
So we'll end with a question for you to think about. We've seen that bonds are way more than just a simple IOU. They're these complex things with a unique mix of risks and rewards. So knowing all that, how does this ultimate IOU actually fit into your financial picture?